Hello, and welcome to the Private Practice Owners Club. I'm your host, Nathan Shields. And today I'm excited to bring on Paul Martin of Martin Healthcare Advisors, who's been helping private practice owners find partners for the past 27 years. He is a physical therapist from a previous decade, just like myself, but has been helping owners for a long time in this space, helping find exit strategies and improvement in their business and whatnot. So after having my podcast going on for almost 8, 9 years now, I'm excited to bring on Paul Martin. Thanks for joining me today, man.
It's great to be here and anxious to explore what we're going to talk about here.
Yeah, exactly. It's good to have you on because you are directly plugged in to the mergers and acquisitions market in the therapy space, and you've been doing it for a long time. I have to ask you right off the bat, like, we're sitting here in August of 2026, and there was a nice hot run on the market for purchasing businesses back when I sold late 2010s, early 2020s. Where would you say the market is nowadays if someone's considering 3 to 5 years from now, or maybe this year or something like that? What would you tell them about the current mergers and acquisitions or M&A market right now?
Sure. To understand the current market, we need to go back just a little bit, maybe not all the way back to 2012, but if you go back to post-COVID, and what we saw post-COVID is there were multiples and there were businesses being acquired for higher numbers than we had ever seen in the history of physical therapy. Primarily, that was during COVID. Acquirers were able to get free money.
Oh, the interest rates were super low.
Interest rates were super low. So they were able to pile up a bunch of money.
Mhm.
And so there were a number of deals that got halted during COVID and came back 2021, 2022. Those deals got richer and richer, and then new deals happened. So companies that went out and were able to sell their business in 2021, 2022, and even into early 2023 saw a heyday of great pricing, great structures, great deals. There was a little uncertainty 2023 going into 24 in terms of interest rates, in terms of the general economy. And so things slowed down a tad during that time frame. And so what a lot of businesses did is they said, okay, we're going to streamline and get ready to go out and do a recap. These are the acquirers. They're going to go out in the big company and have another large private equity group acquire their private equity group. And so that was the plan. And while that was a well-laid plan, what we saw happen in late 24, 25, and now into 26, most of these companies, $50 to $100 million of EBITDA, have come back empty-handed, claiming that the multiples they were getting were the same as if they had $3 million of EBITDA.
Oh, wow.
And so the big end of the market has really been squeezed. So what a lot of these companies are doing is they're going back to acquiring businesses, streamlining their operations, looking for another time where the big markets will open up once again.
Okay.
During this time right now, we're predicting over the next 2 years, there's going to be more sellers than there will be buyers, because all those companies that missed that 21, 22, 23, operating 23, 24, 25 was fairly difficult. Lots of issues with staffing, payers tightening down, lots and lots of challenges. And so a lot of companies are saying, we missed it then, we're not going to miss it now. Companies with under $10 million of EBITDA right now are selling. They're transacting. There are acquirers. There are some new acquirers in the market. Again, the companies that went out, couldn't recap, they're back now acquiring.
Okay.
And so whenever you have a market that sellers are rapidly coming into the market faster than buyers, buyers are becoming more selective.
Yes.
And so while there are still many, there's 25 plus acquirers backed by private equity, only one public now, that's USPT, but all the rest are still in the market, still acquiring, but lots of sellers.
Oh, okay.
And so it's a time where you really need to stand out if you want to get the attention and get to the top of these acquirers right now.
Yeah, so they're definitely not getting the deals that they were even a few years ago comparatively, right?
It's interesting, not like 21 and 22, but the deals are still good.
Are they? Okay.
One of the big companies, I don't name any of these companies, obviously, but they said a company with $3 million of EBITDA will get a 10 multiple.
Okay.
And a company with $50 million of EBITDA will also get a 10 multiple.
Oh, really?
And when you get 3 million down, we have companies with $500,000 of EBITDA. They're getting sixes.
Oh, really?
Yeah. Yeah. Company you get up to 1 million, you'll probably 7 or 8. 3 million, probably a 10. It all depends on the specifics of the companies. But
Yeah.
so multiples and deal structures in companies, let's call it 10 million and less, have really stayed fairly strong
Okay.
as long as you're prepared, as long as you're truly ready for the market.
So if someone comes to you, because you've done this for decades now, someone comes and you says, I want to sell. What is your first question?
My first question is why?
Okay, good
Why?
question.
Is it personal? Is it potentially a fire sale? I just can't take this anymore. But you always want to understand a business owner's reason why they want to sell their business, because then we can back into, okay, what's the value? Are you leaving a whole lot on the table? Is there opportunity in the short term to gain more value? And simply, are you prepared? Are you really ready?
Yeah. Yeah, because I would assume somewhere in there you're asking, how soon are you expecting to get this done? Because that changes the dynamics a ton, I'm assuming, right?
It does. It does. Typically for us, we call it an outside in assessment. And it's the tool that we use to really diagnose for a business and a business owner, how prepared is your company for the current market?
Mm,
So we look at that company through the eyes of the acquirers in today's market, put a value on that business in today's market, and then again, explore with that owner timing and are there levers? These are a lot of the things that you guys do. Are there levers that you could pull to improve the value of your business in the short term or maybe even long term? It could be
mhm.
12, 18 months. At times, these companies are preparing their businesses for the market and they don't want to leave millions of dollars on the table.
Yeah.
You know,
Well,
if you think of,
I was gonna ask that same question. If someone comes to you and maybe they're just kicking the tires, maybe they're in their late 50s, early 60s, mid 50s, you name it, but they're like, I'm kind of tired. I want to see what the potential is. Yeah, it would be great if there was the potentiality for interest rates to decrease here in the short term, but that doesn't look like it's going to happen because there'd be more free flowing money. But on the average, outside of personal circumstances where, yeah, it has to be a fire sale, what are you, how are you coaching these people? What expectations are you laying out for them? This
sure.
is typically yes, we're going to take your information, give you more specifics, but typically you need to give yourself this much runway to really optimize the business based on what we see.
Yeah. That's a smart owner that comes to somebody and says, I'm starting to think about this. I don't want to do this forever. It could be 1 year, it could be 3 years, it could be 5 years, depending upon what's out there. But I really want to make sure that I'm ready. And I think that's somebody who is a really bright owner who is doing the right things. And it's very different from business to business.
Sure.
Some owners have been thinking and talking about this and have been preparing for this moment for decades. Other owners, as you just said, I'm just starting to think about this. I don't know if I'm ready or what the market is out there, but what do I need to know in order to make a good decision on whether I transact or I keep the company longer or I wait and get
Mhm.
more valuable and then I transact? And there's internal things with them and their business, but there's also external, depending upon their market. Are their businesses in the industry today that will acquire that business and partner with that business depending upon their market.
And so do you usually see, you brought up 12 to 18 months. Is that a typical amount of time for someone to, I don't know how to otherwise say it, but to optimize their business for sale? Or would
Yeah.
you, ideally, someone's thinking about the value and the sale price of their company from the beginning, if you will. If they really want to optimize the profitability and the value of their company, that's a high level goal that they've always got top of mind, that we're all going to have to exit at some time.
Yeah. Yeah.
And
Yeah, for
you want to
sure.
be in a
For
power
sure.
position when you do,
Yeah.
and not at the time of a potential fire sale. But if you said, okay, the average owner comes to us, do you usually give them about 12 to 18 months to really optimize things? Or, of course, it could be worse, but would you say the 3 to 5 year time range is a good time to start focusing? How long does that take?
It is. It is. I sold my business back in 1997, and we started seriously preparing in 1993
Oh,
for
wow.
that event.
Okay.
So you really have to work backwards. If you start with the transaction process, so when I say this business is ready to go to market, when that business goes to market, it's typically 6 to 8 months
Okay.
to go through a process, to bring all the acquirers in, go through a process. So then you have to say, okay, from where you are today to a value that will be meaningful enough for you to want to go to the market. And we have to look at where that is. Let's say it's $500,000 of EBITDA, but to the value they want to get to $1 million. And there are three things that can get them there. There's charge capture, there's schedule management, there's working, potentially hiring more therapists and
Right.
making the therapists more busy, working on some other metrics that will drive that bottom line.
For sure.
Then we can look and say, okay, those 3 to 4 things that you're going to do in order to get those up and running and have enough time to prove it out, it's going to take 6 months, or it's
Yeah.
going to take 3 months, or as you just said, it's going to take 12 to 18 months plus the 6 to 8 months. Now you're on a 2 year.
Yeah.
So it all depends on what within that business gets that business owner to a place where they're going to be willing to transact. They're going to be willing to go in the market and get enough in that deal that it's going to make sense to them.
I can see you're coming from a different perspective, and that is more, what do you want to get out of this business, right? That's a higher level question that the owner needs to understand for themselves is, yeah, you could be at, and when we say EBITDA, for those who don't know, that is an acronym for, help me, earnings before interest, taxes, depreciation,
Depreciation and
and
amortization.
amortization.
Got it.
It
Very
could be,
impressive.
it could be similar to net profit, so close to your net profits, right? But they say, listen, I want to get $2 million out of this practice. And then you do the valuation and you're like, dude, you're not going to get more than 1.2 million based on today's market. Now that now determines, you have to figure out which levers you have to pull to, and that's where you do the analyses. And if you do this, that, the other thing, this is how you could get to $2 million. Now it's up to you to pull those levers, and however fast you pull those levers and get things moving can get that valuation to $2 million. But not just you hit the $2 million mark, ring the bell. I'm sure the acquirers want to see a history of something that's along the lines of $2 million in EBITDA for a trailing 6 to 12 months, right?
Yeah.
Yeah.
Yeah, for sure. And you can show those changes. And as you go through a process, you're building some more months. So you don't necessarily have to wait the full year, but it's from that owner. What are your goals?
Yes.
And what is it going to take to be meaningful enough for you to want to do this versus just continuing to keep the company? And yeah, and the net profits, that just brings up something that I just wanted to throw in there, is that many times the way in which people distribute money to owners, the way in which they may treat their interest in their taxes and depreciation, most companies don't really have a good handle on what is their true EBITDA in this market. I'm always careful with some Main Street business brokers and such, and they're going to want to throw all the adjustments in there, and acquirers just immediately will just lose trust and look the other way. So Companies really need to know what that EBITDA really is and
Hmm.
update it on a monthly basis and see that trailing 12
Yeah.
and what that really is. Then they're in touch with, okay, how do we make changes to that?
Yeah.
And once they start seeing those changes, they get real excited. We've had owners get to that 2 million and say, let's keep going. Let's
Oh,
get
yeah.
to three.
Yeah, exactly. There you go. Well, as long as they have some objective reality. And is it enough for owners to trust their CPAs to give them that EBITDA number?
Potentially.
Okay.
It's when you get to the adjustments, and if a CPA does not understand what a physical therapy acquirer is going to accept in terms of those adjustments. So there are different ways to get to that EBITDA, and it's those adjustments that really throw the wrinkle into it. So typically it's someone who has been involved in transactions in this industry that are
Okay.
going to be able to drive that for you.
Because those adjustments that go to the bottom line and can inflate the profits and sometime appropriately. But
Sure,
you're saying there might be
absolutely.
some adjustments that inflate the profits that the acquirers are like, I don't know if you can count those adjustments, right? Is that what you're
Yeah,
saying?
it when you start having the adjustments are twice as much as the net profit, and the large majority of those adjustments are personal in nature, you're just building a big mountain of problems
Yeah.
because you're going to have to explain each one of those and why they're not going to continue on with the business going forward. And
Mhm.
so at a certain point in time, it does not become worth getting that tax advantage. And you want to really clean up those books and get them clean and clear.
Yeah, exactly. Is there what is helping? So you said something important at the beginning or at the front end is that there seem to be or there will be more sellers than buyers. Either that is the market or that's what's in the future. Then how does someone stand out amidst the other sellers to
Yeah.
say I'm worthy of purchase? I'm sure there's plenty of buyers that are happy to take on a fire sale and then they get it at a cheap price and they implement their policy and procedures and their contracts and whatnot and they can maybe work it up. That's not always enticing, but if it's cheap enough because it is a fire sale, then they'll jump. But if someone isn't looking at a fire sale, they're looking to sell 1, 2, 3, 5 years down the road, how do they stand out versus the quote unquote
Yeah.
buyers
And
that
I
do?
will say that most acquirers really don't want fire sales.
Oh, really? Okay.
They'd rather have businesses that are operating well, that they can use their continued rate hikes.
Yes.
They can bring up the payer rates. They can use their resources to drive those companies more. So they don't want to have to fix things. So the more prepared, as I said, the simplest of preparation is making sure your financials are in order. And that realistically could be you may have compiled financials, you may have reviewed financials, which is the next level. For companies over $1 million of EBITDA, we often will recommend having audited financials. That'll add a turn, maybe two, and it'll make the process much more efficient.
Hmm.
Buyers will pay for an efficient process.
Okay.
So the financials have to be in order. And that's because when you think about it, well, yes, they're buying your relationships, they're buying your goodwill, they're buying your markets and your relationships within those markets. But in the end, they're buying your cash flow. And if they
Yeah.
can't see a clearly defined cash flow and all those adjustments are reasonable and within the limits of what they will accept, it becomes a challenge for them and they
Mhm.
will sometimes walk away.
Is it more, I'm assuming it'd be more enticing that there's an owner who has a clinic that is relatively independently operating from them. By that, I mean the owner isn't treating a significant amount of the time. Maybe they've got leadership teams in place that are running systems and there's not a lot of heavy handedness on the part of the owner. I'm assuming those are pretty valuable.
Yeah, the value comes in when you have an owner, CEO, whatever you want to call, and you have clinics and clinic directors down here. But in the middle of that, you have a leadership group that is often director of marketing, director of administration, possibly a chief operating officer, director of operations among that.
Right.
Those people aligned and going into the market, all aligned. There's ways to give those folks interest in a new company. They can
Mhm.
roll some equity forward. When you have that significantly adds to your value and sets you apart from other platforms as well as other businesses. And that's absolutely one of the things that I would say, as you just said, what will add to your value? That's one of the key value add is that middle layer of leadership.
Tell me if there's going to be a lot of people listening who maybe have a singular clinic, maybe two, and even in those two clinics, maybe there's one or two providers.
Sure.
Are buyers looking for smaller clinics like that? Or are they not as excited? What's the market for smaller clinics like that? And how can they stand out? Do they need to grow to 3 and 5 clinics and have a middle layer of management? Or do they have an opportunity for a successful exit as well?
Yeah, great question. And we work with a lot of single clinics, 2, 3 clinic businesses, smaller businesses. We like to call them locally focused, not
Okay.
smaller. And so for businesses like that, it really comes down to the same dynamics. A single site or a 2 clinic business that has zero bottom line is going to be very hard to transact.
Yes.
But if those companies are running with systems, if those clinics are being led by not just the owner, but if the owner takes a couple Fridays off, things go really well. If the owner is willing to stay in a smaller business like that, it's essential. It
That's
really
true.
is,
Yeah.
especially if they have not handed, and most owners in single site, dual clinics have really not handed the keys to somebody else.
Mhm.
So the same, if there's EBITDA, if there's a margin, and if they can see growth going into the future, we call those opportunities add-ons, tuck-ins, and we create a map and we show those businesses where the larger businesses are. Many times they don't know because they haven't changed the name. So they're like, oh, that's a USPT. I didn't know that. Or that's a Confluent. I didn't know that. So there's lots of opportunities for those businesses who are run well, and the owner needs to know the business. They need to know their operating metrics. They need to know how their EMR and revenue cycle management happens, because they're going to be looked at in the future to continue to run and manage those businesses with resources now, but with additional resources.
Yeah, and so educate the audience a little bit. I understand it because having gone through it, but for those owners who are looking to sell, I think, and they might be imagining a dream scenario where they sell their practice and step away immediately, or maybe just take a month or two and hand things over. I Be realistic with us. They're usually expecting what, 6, 12 months, 2 years to stay on?
Typically 3 to 5 years.
3 to 5 years. People need,
Yeah,
and they need to build that into the
they do.
expectation of the sale,
They
right?
do. They do. Now, are there transactions that owners don't stay 3 to 5 years?
Yeah.
Of course there are. But owners that want to cut and run, that's good in the past. That's very difficult to do. Now, you have somebody who has been your right-hand man. They're a therapist, they're a leader. You've gone on long-term vacations. Could look to make that transition over a year or two? Absolutely.
Mhm.
But most small business owners don't have that person, because that person is expensive. And that person, while many times they're great clinicians, they don't really know how to run a practice. The owner knows how to run the practice.
Yeah.
And where these private equity groups who are backing these companies have seen many of the large acquirers of the past fail is when they let the owners leave. And the next thing you know, a year later, the owner's showing up around the corner based on they've waited out their non-compete.
Yeah.
And it's really much more of an owner-driven cycle going into the into acquirers now than
Oh,
it has
really?
ever been in the past.
Gotcha. So that tells me that there's an added importance for owners to have some kind of leadership development program. I'm assuming that would add value if they have
Absolutely.
people in the program and are actually developing into clinic directors and whatnot, and they aren't really hands-on. And then, like you said, they have to know their metrics. They have to have systems in place. If it's all in the office manager's head or the clinic director's head or the front desk person's head and not on paper or online, then it's not
Yeah.
that's not really a system, right? You're just
No.
people dependent and not system dependent. And buyers can sniff that out pretty quickly, I'm assuming, right?
Yeah, we call that the heroes.
Yes.
The heroes can't have the systems all inside them and know, like you said, nowhere on paper, nowhere where it's a weekly cycle, it's a monthly cycle. But those, like you said, small clinics that have those systems built in are still very well sought after, especially if an owner wants to stay and continue to contribute over the long haul.
Yeah. And so the owner, I'm glad you mentioned all this because the owner really has to understand the dynamics that are at play. If they are 65 and they're hoping to sell it in the next couple of years at 67, they might be expected to stay a few more years, and you better plan on being there till you're 70, right?
Yeah. Yeah.
Yeah.
Yeah, for sure. And look, we've seen many owners who come to the table saying, we've heard it's a bad market out there. The acquirers are mean to the former owners. We don't want any parts of that. And then we introduce them to a couple of companies. And we never heard of that company. We never thought that they had leaders that were physical therapists. And we've had companies, they sell their business owners, I'm sorry, they sell their business, they say they want to only stay a short time. 10 years later, they're still in that clinic, maybe 3 days a week.
There,
We had an owner one time in Maryland. He sold his business to USPT, stayed for 10 years.
oh wow.
And then USPT found him a clinic in Florida where he wanted to live,
Oh, funny.
that the owner was leaving. He just took that owner's place, fit right into Florida. His business was fine. I think he worked with USPT for 15 years.
Oh, that's crazy cool.
Yeah.
I want to ask you a quick nuanced question because it came up on our Facebook group a couple months ago because someone was looking to sell. And there was a stipulation in the sale contract. These can be written 1,000 different ways, but I wonder if you've heard this or seen this a lot recently, or if it's been a common thing all along. And that is, they said something along the lines of, if certain people within the organization quit after the sale goes through, then the buyout later on could be diminished. The overall sale price could decrease. Are you seeing more of that, or is that a common thing, or is that just a negotiating point that they can work out?
That sounds a little unusual with people saying if these people leave, the sale price is going to change. Usually it's if there's a worry that people are going to leave, excuse me, they will want to have some form of an earnout attached to that so that they can prove, no, these people aren't going to leave. And even if they do leave, we're going to replace them and the business is going to continue to operate on it at the same levels going into the future. But I've never heard if John leaves and Mary leaves, we were going to pay you another $500,000, but now it's only going to be 250. It's usually more based on performance.
Yeah. Okay.
Now, at a closing, before a closing table, they may say that in order for this transaction to go through, we need John, we need Mary, and we need them under non-competes because they are essential parts of your business that you can't run this business without them. And we need to know that they're going to be there at closing and that they're going to be under non-competes.
I would assume that most providers, they would, if you're selling your practice, that any buyer is going to request that your providers have a non-compete agreement already built in.
Leaders, not typically just regular providers in clinics. Okay. Yeah, not typically. Yeah, they tried that for a while and it didn't go well.
Oh, okay. I understand that. So someone's sitting there and wrapping it up, getting a little bit more into the weeds. Someone's sitting there and they're like, okay, I need to get more serious about increasing the value potentiality of my clinic, or maybe they are thinking 3 to 5 years down the road. What are some of the boots on the ground stuff that they can start doing here in the next couple of days after they listen to this episode? What are some things that you would recommend that they focus on?
Yeah. Yeah. I really believe that before you create a plan, you have to know where you are today.
Okay.
And so I would urge them to get a better understanding of where is their value today and what is their goals of what they need to get out of a transaction. And know that depending upon their size, when you look at those goals, there's what you get at closing. And a lot of people at cocktail parties and these old mergers and acquisition guys, and I don't mean old in age, but they've just been around a long time. And what they always tell people is you can only count on what you get at closing. Okay. And don't let anybody tell you any differently. Okay. In my 27 years, I have never had one client that has not gotten their note.
Nice.
I have had clients that have not gotten their full earnout. Many, though, I can say within the last 5 years, I cannot remember one client that has not gotten their full earnout.
Oh, that's impressive.
And in terms of equity that they're rolling forward, in
Mm-hmm.
most cases, we see that over a 3 to 5 year time frame, double and sometimes triple.
Nice.
So what you really need to see is not just when you're setting those goals, not just what you're going to get at closing, but somebody has to go through with you what typically happens in a deal to see what you'll ultimately get. And are you better off with a large umbrella acquirer with unlimited capital, systems and processes, resources, or are you better off just trying to fight this on your own and get there to a point where what you get at closing is what you really want out of a deal? So there's two things you get out of a deal. What do you get out of the beginning of the deal and what you get out at the end of the deal in most transactions that are happening in this industry. So a business owner really has to take a look at that. So that's the first thing I would have them do is what's my value today and what are my goals and how do I get to my goal? Because if today I have a son, he lives in California. He lives in Santa Monica, California. And if I were to right now say, I'm headed to California to visit my son, I don't know if I could do that without a map.
Sure.
It's a long way away and there's lots of turns to take and there's lots of things, but I need a map. And so the plan on how you get to that point where you can say, okay, now my business is ready and I can choose to continue to run it and make it more valuable and have more cash flow for myself and my family, or I'm at a point where I can choose to take this business into the market and do a transaction. And so if today you got to know where you are, and then you have to develop that plan to get to where you want to get. And then don't go in a closet and not share that. Your leadership group needs to be aligned with that. Now, do you tell them it's about a transaction at certain times? No, because many of those folks need to be brought along. And at a point in time, yes, you could look to align them, have them somehow grow into some equity. We have some growth share programs that we've used that these leaders can grow into equity. Now a transaction is only positive for them because they're rolling their equity into a new, bigger company with more resources, and that equity can then grow and grow. It's developing that plan. Those are the two major things that I would tell you to do. Where are you today, and what do you need to do to get to where your goal is?
Yeah, because you definitely want to put your position in a, you don't want to be going to the table as this is a weak option for me, or you don't want to be, there is a power imbalance, and you want to be the one with the power that says, my company is running well enough, spitting off enough money. It's essentially an ATM. I could sell it or I don't, but maybe I'm kicking the tires to see what people will pay. And if they match my number, then we can have some serious negotiations and go forward with some due diligence. But if I don't, if they can't, then I'm fine with where I'm at. And that's the ultimate power play is like
Nathan, that's leverage.
That's called leverage.
That's leverage. That's real leverage. And you get that leverage when you're at a point where you really don't need to sell your company. You also get that leverage when you do go into the market and you have more than one offer.
Yes.
It's really difficult when you have one offer to then have any leverage with that acquirer versus I have 5 indications of interest here. Let's put them. This is the highest. This is the next. Let's really analyze these. That's when you have leverage as a seller.
Yeah. And you really need to consider that part of your responsibility as the owner, right? Because I said, you're going to leave your clinic, you're going to exit sometime. It's just, is it on your terms or not?
Absolutely. And don't always have it be just the company that called you.
Yes. Because before we sold our clinics, I think we had 3 or 4 offers before we finally landed on the
You
one.
did it right, Nathan.
And the question was always, what does our life look like after this sale, right?
Yeah.
Did we sell just so we can become well-paid clinic directors 40 hours a week again? That's not why we got into business, right? Those are some of the conversations that we literally had when these offers were presented to us. And we also understood that it wasn't the final sale price number that we had to look at. We had a mentor that was smart enough to tell us it's not about the number, it's about the terms.
Mm,
And the terms make all the difference. You could get $10,000 a year for the next 100 years, or you could get $1 million up front. The sale price is the same, but the terms make a huge difference as to whether or not you want to sell at that time or not.
yeah,
So we were able to focus a little bit more on the terms and what our life looked afterwards, and that really was made it easier for us to say yes or no, because I'm assuming you see it quite a bit. There's plenty of buyers that are reaching out to potential sellers.
absolutely. And they're
And
doing what they should be doing.
yeah, owner friends of mine they're getting hit up a couple times a
Absolutely.
month with
Yeah,
opportunities, and they need to
absolutely.
be smart about it, right?
Yeah. We always say, and you bring up a really good point where structure is more important than price. I 100% agree. Before structure, we always say culture. If there's a culture match and a culture fit,
Yes.
and the only way to really understand that is to get in front of somebody in person and have those real difficult discussions, ask those hard questions. So the culture match first, then structure, because there's my Tom Carden, who works as our managing director of M&A, he always says there's 25 different flavors of ice cream out there in this market. Every company brings a little bit of a unique structure. And so that structure is so important. And what will work for you, Nathan, won't work for me and won't work for somebody else. So it's really important to do the full array of structures. And then price. You have a company that's paying a 10 multiple, this one's paying a 5. The structure is going to be pretty hard to beat with a 5 compared to the 10.
Yes.
But price always comes third. Absolutely.
Yeah. I did have a friend last year who sold, and he was excited about the potentiality of it and what this new acquirer could do for him. I think it took maybe 6, 8 months before he split from them because, and it's inevitable. You have to expect there are going to be changes.
Sure.
And not knowing the details of his situation, I can't speak to what went wrong. I know a significant number of changes came into play, which led to a number of his people on the team leaving and him having to figure that out. And he had his discrepancies with the acquiring company. That's where, when you're talking about culture, you've got to expect some things are going to change, but that I call it value alignment. If you guys can be on a shared values basis, then maybe that culture meld can actually work well for each other.
If values are a part of your culture, you have to have that value alignment.
Mhm.
And like you said, it's not uncommon. We did, and
Mhm.
we brought on 10 large company CEOs, and we all asked them the exact same question. What's the biggest lie that acquirers will tell sellers? Number one thing they all said is nothing is going to change. Yes, it is going to
Yes, it
change.
is.
And if you
Yes.
have not built a culture of change, you could be in for, and if you know the limits of what your culture is going to, you got to really test it out before. And you can only test so far.
Yeah.
And sometimes you test and you really, maybe you did make the right and things can happen. But typically when you've talked to 10, you've worked it down to 5, you've got it into 3 and you choose one, that's
Mhm.
your, at least your best opportunity that there's going to be that culture match.
We've covered a ton of stuff, and I thank you for sharing and also sharing your time and wisdom. Is there anything you want to end with as we wrap things up?
Yeah, I think more than anything, again, a lot of folks will say out there, this market is uncertain. We don't know where this market is going. We don't know what's going to happen. What we're saying is that there is a market out there today, and there are acquirers that are coming to processes and are bidding for companies and are doing really good jobs post-transaction, integration, et cetera. So the only time you can sell your company is when there are buyers. We had a company the other day, they said, we're thinking maybe we go into 28 because if we can sell the business in January, we're going to save taxes. So if we can, I said, please do not pit your destiny for a $5 million transaction purely on you're going to save $25,000 to $30,000 of taxes.
Yes.
So yeah, so that is my is the market is there right now. And there are,
Mhm.
and so you don't want to be at the negotiating table and not prepared. So you
Right.
really want to start preparing today.
You mentioned some podcast episodes. What's the name of your podcast?
It is the Next Level Owner,
Nice.
and we have it on YouTube. And I reached my 300th episode about
Congratulations, man.
8 weeks ago.
Way to
So I
go.
don't know if that makes me old or it just means have some experience here.
You're
But yeah, no,
persistent.
we've done lots and lots of episodes. I love doing it. I love doing stuff like this, Nathan.
Yeah.
And so yeah, when we can get in front of physical therapy business owners, we jump in front of them.
That's so cool. And how can they find you
Yeah,
outside of the podcast?
it's
Okay.
very easy. The name of the company, www.martinhealthcareadvisors.com
I'm glad you said advisors because everyone's going to
with an
keep
S.
ER or OR.
OR, yes, advisors.com.
Ors. Yeah,
Yes, you
I
got
get
it.
it. Great. And everyone can see you at PPS. You're there every year. You're going to be holding a session there at PPS so they can look out for that as well and get in touch
Yeah,
with you, right?
myself and Steve
Stalzer.
Salzer. Yeah, myself and Steve Stalzer are going to be doing that. And I'll also be at Therapy Con next week
Oh,
or
yeah,
this
that's
week.
right.
What am I saying? This week. Yeah, this
Oh, okay.
Thursday.
Unfortunately, our audience won't be there that quickly. This will probably release in September, but they ought to look out for you at PPS and check out your
Absolutely.
podcast for sure. Thanks for taking your time, Paul. I appreciate it.
Yeah, great talking to you, Nathan.